This is Andrew Stotz of Stotz Investment Research, looking at 5 components of stock market returns. And in particular, I'm going to be looking at Taiwan today. So 5 components of stock market returns. One is based upon dreams. So in the world, the dream factor, which I'll tell you about more in a second, just returned to positive contribution since the global financial crisis. Since 1990, if you had put $100 into the market, it would have grown to be $8.99. Now, if we look at Asia ex-Japan, after the global financial crisis, the dream factor has hardly contributed to return. Since 1990, 100 would have grown to be about 1,000. And in Taiwan, dividend contributed half of the return. What you'll see is that since 2000, 100 would have grown to be 314. That's over 17 years, 18 years now. I only go to 2000 for Taiwan because of some data issues. Now, let's look at 5 components. What are they? Number 1, everything you buy has inflation in it. Number 2, a company has a dividend that it pays out and you're paying a price for it. That's the dividend yield. Real book value growth is what's retained in the business. And then there's share dilution, which is captured in the real book value growth. And then finally, there's what I call the dream factor. So inflation, of course, is about prices rising in a country. Dividends relative to price give us our dividend yield. And the real book value growth is how much retained earnings add to book value. And then share dilution is the impact of share issuance. Hopefully, it's a positive impact. And then finally is what I call the dream factor, where we have volatile, dreamy visions. So let's look at this. The first 4 components all have one thing in common, and that is they can all be calculated from the most recent data. In other words, they're all backward looking. But the dream factor is what people are expecting in the future. So it's forward looking. The portion of the market return that cannot be explained by the prior factors is explained by investors' expectations of the future. Dreams are positive expectations of massive profits, and nightmares are negative expectations of collapsing profits in tough times. Now, dreams drive investors to pay a higher price for the same amount of earnings or book value. Now, of course, they're expecting that things are going to change, but when things do suddenly re-rate or derate, this is what's happening. Nightmares make investors willing to pay or to accept a lower price for the same amount of a company's earnings or book value. Simply, it's when a PE or price to book re-rates or derates. So let's look at the world, and what we can see is that the number on this chart is the total return of the world equity market. So in 2017, the world equity markets were up a whopping 18%. Now the red bar is the dream factor. That's the re-rating, de-rating component. The world hasn't seen a large negative dream factor since about 2011. Real book value growth turned positive in 2016. So now what we can see is the dream factor was high in 2017. Now, if we take the data from this chart and we now take this exact data, but now we cumulate it, so it's a cumulative number, what we can see is that if you'd put in 100 back in 1990, you'd end up with 899. And from that 899, there would be 799 of return. 253 of that was from inflation, or 32%. Book value was 217 of that, 27%. Dividends, 239 or 30%, and the dream factor was 11%, about 90, 11%. Remember that number. Now let's look at Asia ex-Japan. We can see a lot more volatility in the market, and we can see a lot more volatility in the dream factor, right? So, and of course, dream factor hasn't contributed much until 2017, when the Asian ex-Japan market went up 32%, driven mainly by the dream factor. But if we were to do that data on Asia ex-Japan on a cumulative basis, 100 invested at the end of 1990 would have grown to be 1,003. Inflation was 400 of that, 900 return, or 44%. So the majority of it really, no other component was as large as inflation. Book value growth was 187 or 21%. Dividends was 29% of that total return, and the dream factor, not 11% as we saw globally, but 6% in Asia. So I would argue that the valuations have not been re-rated in Asia to such an extent that they're overly expensive. Now let's look at Taiwan, since today I'm getting on a plane to go there. And what we can see is I only went back to the year 2000 in this case, so it's slightly different time period. Dividend yield has consistently contributed to the return. We can see the green bar there. Now let's look at this. First of all, let's look at both 2016 and 2017 both had positive returns of 10 and then 16%. And if we look at this on a cumulative basis, we can see that 100 invested at 2000 ends up being 314. Not a great return, but of course we're not looking at the same numbers as we looked earlier. So inflation was 32% of that, or 15%. Book value growth was 43% or 20%. And here is the main one. Dividends was about 50% contribution. The one thing we can see now is that the dream factor has re-rated. If we go back to 2000, the dream factor has been a recent positive impact of about 15% or 31 of the 214 return. So there you have it, 5 components. We can see the world, the dream factors just returned a positive contribution since the global financial crisis. Since 1990, 100 would have grown to be 899. In Asia ex-Japan, dream factor has hardly contributed as of right now, and 100 would have grown to be about 1,000. And in Taiwan, dividend contributed half the return. 100 would have grown to be 314. Not a great return since 2000. I hope that helps. If you have any questions, let me know.